Hello. So today we are going to talk about L1 derivatives, with which we are going to talk about future markets that involves currency, gold, crude oil, and agricultural products and other metals, everything. So as we go with this, we'll see how we can proceed further. So here I am Prabhat Kumar, your instructor, and I represent Investors Delight. So in future markets, we can see that future market terminology is there, like current future, currency future with example, then gold future with example, crude oil future with example, copper and aluminum future specifications, and so on. So as we proceed further, let's go with the future market terminologies like commodity future market. Commodity future market is something in which we involve all the agricultural products like wheat and rice and everything. And then we have commodity future products contracts. So contracts are future options and all. And then we have open interest, all the unsettled amounts that comes under open interest. And then we have future delivery, what we put into delivery upon expiry, those things comes under future delivery. Then we have future expiration, so expiry date is there for all the contracts, so that comes under expiry. And then we have volatility, we have to understand the volatility of all the prices of the underlying. As we know the underlying prices volatility, we can understand how the future contract will change according to that, or the price will change for the future. And then we have historical and implied volatility that we have to consider. Then we have hedging, we are hedging things. Sometimes speculation is there, sometimes hedging is there, and sometimes we have arbitrage opportunities, so we'll discuss this also later. And then we have order types. So with order types, we are going to give different types of order, market order types, then limit orders, as we discussed earlier also. Then we have forward curves, we have to see how the forward curves differ. And then we have backwardation and contango market, we have already discussed. And then we have mark to market, we have to do mark to market when we go about the margin system. We have to do mark to market to figure it out what is the margin call and how to settle all this, and that is required. Then we have OTC markets, over the counter markets. If it is future markets, then it is exchange. If it is forward market, we have to settle everything onto the OTC markets. So these are some basic terminology which I explained in brief just now. And then we have what are the currency futures. So currency futures is the difference, we have to understand the difference between the spot rate and the future rate. So what is the spot rate means? Suppose we have given the rate of USD INR currency. So how INR is quoted per USD dollar. So that is currently it is around 80 rupees per USD. So this is the spot rate currently. In future it can be 82 also. In future it can be 75 also. So this is going to be the future rate. So future rate is something which we estimate or which we bring into our contract by some of the laws and some of the variables that we have discovered so far. So mathematical functions also we use in all that thing. And then we have a currency future example. For example, US based company is XYZ and it has projected receipt of 125 million euros in September. Since they know that they will receive euro, they can sell it now and lock a rate in which those euros can be exchanged for US dollars. And the company XYZ sells 1000 future contracts on euro to hedge its projected receipt. So they know the difference of the USD versus euro, and based on that, for 125 million euros, they are selling 1000 future contracts to hedge their risk, so that the rate is locked for them. So this is the example of a currency future. We have similarly gold future, and in gold future, what is there like in one gold future available in US is like COMEX. This is 100 Troy ounce contract, and in India, if you see, you can invest in various sizes of gold futures like 1 kg mini, that is 100 grams, then Guinea, that is 8 grams, and petal, that is 1 gram. So even from a small to large, we can invest in all variety of gold futures. And in India, gold futures trading happens in multi commodity exchange, MCX we call it, and the gold future market is highly leveraged, and the margin requirement is only 4%, and 4% means you can understand that you can take position in gold future up to 1 CR by paying only 4 lakhs in the margin. And various other facts related to gold features with all the different contracts are given here. You can see the contracts is given in the first column, then price quotes is given in the second one, like 10 grams, 10 grams, 8 grams, 1 grams, likewise. And then we have lot size is given 1 kg, 100 grams, 8 grams, and 1 grams. And then tick per size is given, and then we have profit and loss per tick is given, and delivery units is given. So this is the way gold futures are traded in India. And then we have crude oil futures. So as we saw the gold futures, currency futures. So what are the crude oil futures in India? The market value of a specific grade of crude oil is established by two main factors, like we know, density and its sulfur content. And these types of crude oil, as we see, is West Texas Intermediate, Brent crude oil, and Middle East crude oil. So these three types of crude oils are there. Further factors responsible for price movements are, you can see, weather conditions, then speculative buying and selling, OPEC output, then changes in the refining sector, US crude and product inventories data, a drop in the refinery utilization rate. So we have to keep note of all these regions, and then we can estimate whether crude oil futures will go up in future or go down in future. Currency fluctuations and weather conditions are also important. And when it comes to selling it on MCX crude oil exchange, then we have to see the price quote per barrel, lot size, 100 barrels, tick size, 1 per rupees 1, then profit and loss per tick, expiry, then delivery units, physical delivery, snapshot of crude oil market depth, and all these things we have to consider. And this is all the details that we have. Further to the copper and aluminum futures, you can see some specifications are given here. So, like other things, metals like gold, aluminum, and copper are also traded, and their specification is given here. You can see, and maximum order size you can see is 70,000 kilograms for copper and 1,50,000 kilograms for aluminum. So that way you can go on trade of all these things. Lot size is 2,500 kilograms for copper and 5,000 kilograms for aluminum. So this is the wider specification of copper aluminum futures. And with this, I just end the section, and I would like to thank you. We'll meet again.